Hey everyone, welcome to Leading Indicator, a show by Public.com focused on gaining insight from the world's very best and top macro minds. I'm your host this afternoon, JD Durkin. We are with you today to gain insight into U.S. interest rate expectations, the financial health of the U.S. consumer, as well as economic impacts on the weakening Chinese economy. As always, don't forget to like, comment, and subscribe to our YouTube channel for more in-depth interviews to help you keep up to date with the latest investment news. Very excited to say our special guest joining us for today's interview is Steven Van Metre, the president of Steven Van Metre Financial. Steven, welcome to Public. Thanks for being here.
Jay, it's a pleasure to be here today.
It's great to have you. So let's start with the health of the U.S. consumer itself. Steven, we did see the San Francisco Fed recently release a report about excess savings that were obtained by consumers during the COVID pandemic. Surprise, surprise, those savings are essentially now nearly entirely spent. Expectations for it to be completely depleted during this current third quarter of 2023. What implications do you think, Steven, could these depleted excess savings have overall on consumer spending?
Yeah, JD, that report was really interesting because there's been just so much speculation, mainly because we don't really have great data that shows kind of how much of this pandemic money is left. And we've been hearing from a lot of the bank CEOs suggesting that no, there's quite a bit out there and there's enough maybe to drive the economy. And then we get this Fed report out that effectively says, as you know, at the end of the third quarter, it's probably all gone. And if this is the case, and we'll have to assume that they're correct, and this is what's really giving consumers that just a little bit of extra money to afford these higher prices, if that goes away, of course the dangerous part is not just if that money goes away. There's another big thing that's coming, JD, and that's the resumption of these student loan payments. So for me, it's kind of a double whammy on the economy. We're seeing total compensation growth. This is hours worked. At the same time, hourly wages start to slow down. And if this money's going away and we have a resumption of a brand new loan payment, it tells me that the U.S. consumer is going to face a huge headwind. And that's going to lead to a big slowdown in discretionary spending for the economy. And of course, that's, again, we've been hearing the services sector is driving everything, and it's going to pull the U.S. economy up and out of this manufacturing slump. Not a chance if this Fed report is even remotely close to being right. And whether they get the right month or if it's off by a month, it doesn't matter. This tells us the U.S. consumer is now going to see what we're seeing from consumers around the rest of the world, and that's a big slowdown in spending.
Steven, would this have been about the appropriate timetable of your expectation? You go back to the 3 different tranches of federal government dollars in the form of Uncle Sam bucks or stimulus payments, however you want to frame them. Kind of mentally, as you sort of gamed this out, I'm curious, was this more or less about the time that you thought, all right, by about Q2, Q3, summer, fall 2023, we'll be near our depletion cycle, and then it comes time to kind of start to shift the conversation?
JD, I thought we'd probably spend through it a bit quicker, but there's a secondary factor here. Is all that money did create prosperity. I mean, people, they made more money. The people were getting bonuses. Salespeople were making commissions. So the money did cycle through and create money into the economy. Banks were lending. So there was a lot of things going on. And so I would have thought just if you go back to normal, one-off stimulus, so here's $400. I mean, that money just vaporizes in and out of the economy. But there was just so much money that we have no historical guide for this. But I kind of figured by summer it would around, so an extra quarter. Does it really make a difference? It does, because the summer months are so critical for the economy. I mean, you have so many businesses, they need to make a lion's share of their money in the summer to get through the winter. Well, now the problem is if winter is just a bust, and we're looking at the holiday season, we're seeing still a lot of trade going on to refill shelves for the holidays. If that's an outright bust, man, we're going to have so many problems going into next year. It's going to be hard for me to see how we're not even talking about a recession in the first quarter of next year, maybe if not going into kind of late fourth quarter.
Steven, talk to me more about the resumption of student loan payments. We know that this is something that President Biden and the Biden administration have largely tried to prevent. We have followed the headlines about these issues being locked up in the court system, being litigated. We know the Supreme Court has weighed in on at least part of the equation. But talk to me more about what you think you will be most closely following over the course, especially as we get closer to September and October, when a lot of these payments are due to resume, and what you think that will do in terms of a bit of pressure on consumer spending, which might actually kind of work to the benefit of one of the goals of the Fed, right? It might be kind of an counterintuitive way to get there, But talk to me more about that, because I think it's been easy to sort of push that out of our minds for the last couple of years, but it will soon be a new economic reality for many families.
Yeah, you're absolutely right, JD. And kind of my expectation, just in talking to people, and I personally don't have any student loans, but talking to friends and other people that I meet that are facing this issue, my assumption would be is if they're not used to having this payment now, we're dealing with inflation, rents are up, fuel prices, everything was up, and people have adjusted to that. And I don't think they have, 400 extra bucks in their budget. So what this means is going into, creating some runway into that payment resuming. A household has to sit down at some level and say, how are we going to get this in our budget? We have to start cut spending somewhere, or they're just not going to make the payment. Now that could be happening too. And I hear a number of people say, you know what, I don't care if they return it back on, I'm just not going to pay it. Well, that could be a disaster as well. But from the onset of it, I would expect to see a slowdown in consumer spending going into October. And then I think after that, there's going to be a really hard adjustment. Now, you're right from the Fed's perspective. This is just a weird way maybe the Fed could get to their goal is, we know Fed wants to reduce consumption. Well, one way to reduce it is, they're driving up interest rates. So that means credit card minimum payments are going up. But this extra payment, if a bulk of the student loan borrowers start making that payment, well, it's got to come out of somewhere. It's going to come right out of the discretionary spending in the immediate fashion. So yes, could this get the Fed to their goal? Absolutely. Could it get the Fed to overshoot to the downside? Well, I think that's the risk the Fed doesn't even want to think about.
Yeah, for sure. It could cut into spending on things like trips to Europe, Taylor Swift concert tickets, you name it here. We know the way that American consumers have been spending. I do want to ask you about the job market. I mean, even on the low end in terms of non-farm payrolls, we're in the 180, 187 range, which is low in terms of the recent historical average. But the big picture terms, this is still a very strong job market. We know where unemployment is falling all the way down to 3.6 and then again to 3.5%. Talk to me about your perspective, your thoughts, Steven, on the strength of the U.S. job market as we're having this conversation mid to late August.
Yeah, so I don't think the labor market is all as strong as the reports are suggesting, JD. I mean, when we look at the non-farm payroll report, which is probably one of my least favorite reports that the government puts out, and I say that because it's designed to be smoothed out. So, everyone gets excited, maybe it's actually worse than it is, maybe it's a little bit better. It's the trend that we care about. So is payroll growth slowing here? Because if you go back to prior recessions, you can actually find out that non-farm payroll doesn't even go negative until kind of sometimes even late recession. So the idea that this is a great recession indicator for me is not really there. What I really like is the initial weekly claims. And I particularly like the 4-week moving average. I look at that. If that trend is moving higher, if continuing claims are actually flat or trending higher, to me, that's a better pulse of what's going on in the economy. Now, we've seen a little bit of pullback in initial claims here recently, giving people again excitement that, hey, the economy is really strong here. But there's another factor I think a lot of people are missing, JD, and that's coming out of the pandemic. A lot of skilled, highly long-term seasoned veteran workers, they hung up their hat. They said, look, the market's going up. I don't want to deal with this COVID thing anymore. I'm just going to go home and I'm not going to work anymore. So you saw a big influx in non-skilled workers come in there. The productivity level tanked. I mean, we could just see that on the quarterly chart. I mean, this thing just went into the toilet, but it makes sense. But now all of a sudden, we're seeing this workforce get trained up, and employers are saying, look, I just trained them. If I let them go, now I'm back where I started. So we're seeing them hang on. But if the slowdown continues here for another couple of months, I suspect we're going to see an uptick in these initial claims. We're going to see some of these workers leave. Now, the problem with that is it's not so much that maybe they can't eventually get reabsorbed. The issue is when you go on unemployment, you don't get your full paycheck. And that, again, now you tack into, hey, we've got student loan payments back. We still have inflation running fairly strong. And now your check isn't as much. That's why you see these rising claims in the data tend to follow into a recession because it's a kind of a feedback loop that occurs here.
No, fair enough. I appreciate that context. You've mentioned recession here a couple times. So reiterate for me kind of what your base case is in recession. Will we hit one? Will we hit one? And if so, when? And what is your expectation there for that unemployment figure at 3.5%? And I'd imagine you see that coming up north of 4% at some point, perhaps?
Yeah, I see the employment figure go up. So you start looking at recession. This is where you get into those inverted yield curves. And this is fun because, as you know, JD, they're a terrible timing mechanism, yet everybody wishes they were. And you hear it all the time. Well, they've been inverted for 6 months, we didn't get one. Then it was 9 months and we didn't get one. It's not about the fact that we have an inversion and so many months go by and you get a recession. We come back to where we started this conversation about pandemic stimulus money. So the inversion is really giving us the critical factor here. It's telling us the monetary system is experiencing deflationary money. Now, the problem is if your plate is already full of money, well, you've got to clear through that before really the inversion has an impact on the economy. So we can go back to prior inversions and say, well, gee, the curve only marginally inverted, following, of course, the 1980s inversion, which was just massive. But all the inversions after that were fairly minor, and then shortly thereafter we had a recession. And now we have this massive inversion, and what do you see after a while? Well, the inverted yield curve, that doesn't matter anymore. Nobody cares about it. It's not right. Well, no, the issue that nobody can see here at JD is we have to chew through all of this pandemic stimulus, which makes that, of course, that Fed report where we started really critical. Because if, like I said earlier, if they're right, whether they're a month or two off doesn't even matter. If they're remotely close to being right, what it tells us is these deflationary money curves are about to smack the economy in a big way, suggesting to me, I think we're looking at, fourth quarter, the recession talk will be big. By the first quarter, it will be very obvious. And I expect to actually see an uptick in the, claims and the unemployment rate here in maybe the next 3 months.
The central bank is inextricably tied to all of these conversations, Stephen, as evident by the fact of how our conversation has gone so far. Give me your thoughts on further rate hikes and any expectations, I wonder, that you'll be looking for when we hear from Chairman Jerome Powell at his anticipated Jackson Hole speech in just a few days.
Yeah, so I expect Powell will do what he wants to do, and that's continue to raise rates. And I don't know how much he really wants to raise rates, as much as he's frustrated that he's tightening monetary policy as if the Fed has this magic control of the system. Of course, at least that's the belief. And what do you see? The stock market's been going up enough to say, hey, we don't care what you say, Powell. We're still buying equities. And we go back to that old famous rule.
Well, Stephen, what happened? What I was about to say, what happened to don't fight the Fed? This has been a market that has wanted to fight a Fed since spring, summer of last year, no?
Yeah, absolutely. So investors, before were like, don't fight the Fed. Well, now they're exactly doing that, which is baffling, right? Rates are going up. The Fed is very clear. Quantitative tightening is going to go on for, infinity when it likely won't. So I expect on Friday Powell to come out and kind of act like rates are going higher. Absolutely. He's trying to show the world that he actually is in control of the financial system. He just doesn't realize the fact, and maybe he does, but the Fed just doesn't have the control like they did back in the 1980s and the decades before. It just doesn't work that effectively anymore. But there's one way to make it happen. You just keep doing what you're doing until the eventual reaction function happens, and then you can take credit for it. The problem is, when he does get inflation down, he's going to have a whole other banking crisis, because what are we seeing out of the small and mid-sized regional banks? That weekly program from the Fed, they're still taking more and more money. So, granted incrementally more, but the fact of the matter is the banking system's not healing. Who cares if inflation goes down? Because if inflation goes down, what a lot of people don't really understand about the CPI is not just prices. You mentioned kind of demand a little bit ago, JD, when we talked about the student loan payment resuming. So now we have another factor is maybe the CPI just isn't about prices. It's giving us really a pulse of what demand is. And if demand is coming down, then unemployment rates are going to go up. And next thing you know, everything's going to come falling apart. Sure, Powell can at least take credit that he says, hey, I got inflation down, but at what sacrifice? You blew up the banking system, you drove the economy into recession. Yeah, good job, buddy. You killed demand and then some.
I do want to shift to the international outlook a little bit. Stephen, as you know, more worries about over China's economy. They're rising after exports out of that nation fell nearly 15% for the month of July on a year-over-year basis. What do you make of the recent headlines that we've seen out of weakening concerns out of China, and what led to the fall specifically in exports for last month, do you think?
Yeah, so China is really interesting, JD, because you look back in history, and I think this is hilarious because back in 2015, 2016, the global economy is slowing down, and China injects a bunch of credit, pulls the global economy out of it, and everyone to this day says China did it. Great. So now all of a sudden, the global economy is slowing once again. And what do we start hearing out of the media is, oh, don't worry, China's going to stimulate their consumers. They're coming out of that COVID zero. They've got money in their pocket, kind of like Americans. And boy, they can't wait to spend. And the doors open, they walk out, they look around and go like, yeah, I'm not going to spend that much. And all of a sudden, this notion that China's going to pull the world out of the slump has turned to, oh, well, China's about to implode, but that's not going to affect the rest of the world economy. Well, you can't have it both ways. Yeah. And in a globally synchronized economy now, which is dangerous, you look at China, you look at Germany, you say, look, these economies are literally getting crushed. And we haven't seen them go over the cliff yet. But I imagine we could be weeks away, maybe months, I don't know, somewhere in here, China just loses complete control. And we're seeing that happen. And will it have repercussions for the rest of the world? 100%. There's no doubt about it. You go back to the global financial crisis, these little subprime mortgage bonds started to break and fall apart, and people start getting paid. And what was the answer? Oh, that won't affect anything. Oh, it did. And now what are we seeing out of these property developers from China? They're not making their bond payments. And then you see the investment trust, and they're like, well, okay, a couple of us are having a problem. It's a contagion risk, JD. You know this. It spreads. Maybe not all at once, but at some point that fire starts to burn and spread. And next thing you know, you find out that maybe your pension fund owned those Chinese bonds. You just don't know, but it's gonna get here. We just don't see it yet.
Yeah, we saw those Evergrande-related headlines a week ago with regards to declaring bankruptcy, at least here in the U.S. core. I don't want to needlessly get into politics about this, but I suspect this is going to be something we're going to hear a lot about later on this week. The Republican candidates will be squaring off in Milwaukee, and all of them on that debate stage. And this is true for all politicians. I think running for president, running for Congress, they like to communicate to American consumers and their constituents they can play tough on China. And so I wonder if there's anything in terms of policy or public posturing that you think is advantageous for elected officials in the United States to have in terms of the appropriate path to dealing with China, something that I'm sure they'll all be communicating and making headlines about in the coming days to American voters.
Yeah, one of the problems, JD, is literally politicians, presidents, elected officials, they have no clue how the global financial system works at all. They don't understand that we need to be exporting dollars through trade. So earlier you mentioned, hey, Chinese exports are down. Well, that's a big issue here, because we need dollars to get to China because they're the world's largest exporter. They need to manufacture stuff and ship it around the rest of the world, and dollars need to be circulating around. Well, they're not. So the question is, where are all these dollars right now? Oh, well, it's really easy. They're stuck in the commercial banking system and the banks here. Why? Because the Fed has jacked up short-term rates so much that you're not hearing, from the consumer now that says, hey, you know what? Rates are zero. I should just go buy that new car, or go buy this, or go do that. Now they're even telling their kids, man, you've got $1,000, go buy a CD at 5%. So all this money is getting trapped into the U.S. and is not mobilizing, and it desperately needs to. So you hear from politicians, well, we need to bring manufacturing back home. Well, I get it from an emotional standpoint, but from how the global monetary system works, we need China to be the manufacturing powerhouse, or somebody. We need those dollars to leave the U.S., go overseas, and what are we seeing in reverse? China's exports are crumbling. Their economy is getting choked due to a dollar shortage, and what are they going to start doing? Exporting deflation, and that's just going to pile onto the fact that the U.S. economy is slowing, the Fed's going to overshoot to the downside, and next thing you know, the talk won't be about an overheated economy or a resumption in inflation coming back. It's going to be, how do we get out of deflation, Fed back to zero, and all, of course, where we've seen this playbook before, was called the global financial crisis.
Stephen, you're litigating the case on international trade really well. And one more question here with regards to China. Your sense on the impact of a weakening yuan on the overall international trade landscape. And I'm curious how closely you follow that and how it sort of feeds into your overall thinking, even about issues here at home.
Yeah, I do follow the global currency, particularly the yuan right now, because China is just a hotbed of information. I think, JD, what a lot of people don't understand about currency, at least fiat currency in general, The value of it has much to do with demand for it. And so you look at global trade, we see it out of China plummeting. We know that people in China are trying to get their money out of there. Of course, if you're seeing the fire start to burn into their financial system, and you've seen this, happen before, again, you saw it in the U.S., you've seen it in other places, you want to get your money out of there. So what we're seeing in the yuan is just a reflection of the fact there isn't demand for their currency because trade's going down. Now, some of that's flowing into U.S. equities, which is, again, a good thing for U.S. investors. We see it flowing into the dollar. But at some point, when the U.S. data continues to slow down, what you're likely going to see is the dollar weaken too, which, of course, we know China would love to happen right now. But then again, it's all about global trade and demand for a currency. As it slows, all of these fiats are coming down.
Steven, this was an outstanding interview. We all got smarter together, which is really great. My special thanks to you. That's Steven Van Metre, president of Steven Van Metre Financial. Join us for today's edition of Leading Indicator, a source of insight from the world's very best macro minds. Steven, thanks a lot for taking the time.
JD, it was a pleasure. Thanks for having me on your show.